Hello, my name is Larry White, and welcome to the August Resource Consumption Accounting Institute webinar and discussion. As always, I'll speak for about 20 minutes, and then I'll open up the unmute everybody and allow for comments, discussion. Today we're going to be discussing applying the conceptual framework for managerial costing to the federal government. The Conceptual Framework for Managerial Costing is a statement of management accounting by the Institute of Management Accountants, and it's available on their website, www.imanet.org. And this topic of applying the conceptual framework to the federal government is also an SMA by the Institute of Management Accountants. That's a statement of management accountant, and is available on their website. Now, what makes this presentation a little bit different is, of course, I'm going to apply, we're going to talk about it in the context a little bit of resource consumption accounting, because resource consumption accounting is the most comprehensive approach to applying the conceptual framework of managerial costing to any sort of organization, and that applies to government. I always show this slide at the beginning. RCA is a combination of German management accounting methods, which provide a very capacity-oriented view, which I think, as you'll see, is important to the federal government, and it provides the process view of activity-based costing. It's focused on, RCA is focused on internal management decision-making, linking operational metrics to finance, and maintaining clear cause and effect relationships. Now, this is the main diagram from the Institute of Management Accountants Conceptual Framework for Managerial Costing. And the conceptual framework is focused on, again, internal decision support. It doesn't offer any compromises in terms of mandatory or regulated financial reporting. So it's all about creating management decisions. It's guided by two key principles. Number one, causality, which means modeling cause and effect relationships, and analogy, or using information logically. And then there are concepts that support, that I'll show you on the next slide, modeling and concepts that support the logical use of information. The goal of creating an internal decision support model can be realized by creating an operational model of your organization, its resources and operations, and then costing it. Now, that doesn't sound like anything too novel, but in most cases, the cost accounting or costing models you see are financial models that are approximations of operations. They're done fairly independently to approximate. In this case, we flip that around, and it's an operational model that you then cost. And that's a very important differentiation. And then that operational model of your operation is used as your baseline so that you can optimize from there to continuously improve. So these are the concepts. I'm not going to go into them. The documents are available on the IMA website. But one of the things that I do need to mention is that the federal government has really spent billions, maybe even 100 billion or more, to achieve financial statement audits. But there are numerous reports that show that the quality of the management information has not significantly improved. There's a reason for this. There's a critical gap in that there's no definitive guidance on costing for internal management decision making. Now, some people would say, well, the public sector gets by on financial statements. Well, it does kind of, but then revenue, cost, and profit are very clear and very important to private sector organizations and their long-term sustainability. In government, there's really no financial equivalent to profit. There's only budget as an input, cost, and then performance, which is really hard to place dollars on. What's the impact of this critical gap? There's inconsistent cost information and a much higher risk of making poor decisions. Analysts are basically on their own. The quality of their data and the information they create varies, and special analyses are hard work. And in many cases, they are bulldozed because they don't reflect what's in the financial accounting system because of differing principles and concepts. What's the solution? The IMA Conceptual Framework for Managerial Costing is focused on operational and cost information managers need to make decisions that optimize their organization's operations. So the CFMC creates the knowledge and, very importantly, the terminology, the principles and the concepts to talk about and create managerial costing information. It constitutes a body of knowledge about how to apply money to operations and resources. So there's a few challenges. What about Statement 4 in the Statement of Federal Financial Accounting Standards? It's called Managerial Cost Accounting Concepts and Standards for the Federal Government. Now, I don't want to denigrate Statement 4. It is without, in my mind, the best cost standard ever created for financial reporting. It recognizes other uses for cost information, and the Financial Accounting Standards Advisory Board for the federal government is really about general purpose financial statements, financial reports. It's not about management. If you think about it, responsibility for management rests with the Office of Management and Budget. There are many definitions of cost. The term cost is used in a huge number of ways. Cost of major programs, cost of assets and inventory, cost of providing services, the full cost, the marginal cost, the incremental cost. There's working capital funds, government contracting, cost standards. No one figure will do it all. There simply is not one version of the truth. So it's important to understand what are the relevant versions of the truth for particular uses. And then, does the federal government does a federal cost framework purely for management decision making make sense? Well, I would argue it does, if you want cost to be a powerful tool for decision making. And I think every taxpayer would like to see that be the case. Yeah, there was a National Academy of Public Administration study in 2014 that identified numerous problems with the management information of cost. It did not, however, identify the core problem nor present a core solution. We believe using the conceptual framework of managerial costing, recognizing a separate framework for internal decision support is the way to go. Now, we've identified 4 key problems and 4 recommendations associated with federal costing. So the first issue is that the official an audited report of cost data is the statement of net cost. But it isn't used for decision-making, budgeting, program management, or planning. That doesn't mean just the report itself. It also means the underlying data. Let's look at a statement of net cost for the Department of Homeland Security. And what you see here is that most of the costs are spread to major programs. They're spread to the bureaus that are under the Department of Homeland Security, Coast Guard, Customs and Border Patrol, Immigration's Custom Enforcement, TSA, and so forth. Then you have to ask, do the bureaus link that data to specific resources? I know the answer is no. Is the overhead that's associated with this spread like peanut butter across all the missions? I'm afraid to say that for the most part, if you dug into this, you would find it was. And we have a problem with the definition of cost. It's basically expenditures during that 12-month period. And it doesn't really tie to budget, which is what most managers manage. The focus of the statement of net cost is really on the tie to other financial statements to support audit. So if it just so happens that the statement of net cost shows a bad picture, agencies tend to use it to scream about reductions. If they happen to get rewarded with some funding, there's a lot of joy if they're funded. But the causal connection to resources, operations, and performance results is extremely weak. Issue number 2. The federal systems and analytical doctrine are oriented towards reporting compliance rather than decision optimization. Essentially, full cost is the gold standard according to statement number 4, and much federal financial guidance and most budgetary and operating decisions are marginal or incremental. So the term full cost sounds like a robust cost figure, but the name is misleading. The value computed for cost and the granularity incorporated can vary widely depending on the design of the data connected and the manner of the collection. Let's illustrate by looking at a program that inspects certain facilities for environmental compliance. Typically, the salaries of inspectors, the program staff, and the adjudication staff for fines and penalties are identifiable to the program. However, the cost of training, travel, and other direct expenses for the staffs is probably identifiable to the program. The cost of buildings and equipment for personnel may or be identifiable or may be based on an allocation for which the causal relationship of the allocation basis may range from very specific to very general. The cost of personnel support, contracting support, accounting support, higher level administration and management support may be allocated based on very generalized drivers, or it may be treated as a central cost of the organization. So, all of those things I mentioned is enough information to create an auditable full cost. However, the important information needed to manage the program isn't known under this approach. For example, how much inspector time is available in the field? How much time and money is used writing up the inspection? How much time and money is spent on improving the knowledge of those regulated? What are the most and least expensive types of inspections? What categories of customers create the highest cost inspections? How much idle time do the various categories of personnel have? What would be the cost savings or increase in available inspection time if inspection documentation time could be cut by 30% with better software and hardware? These types of questions are simply not answerable with the data that's produced today for financial statement compliance. Federal government agencies aren't devoid of this type of information. Many agencies have operational systems that generate useful and relevant non-financial performance information. However, those mission systems are often not well integrated with cost systems. Issue number 3 is that federal government cost methods and systems don't provide the information to optimize the quantity and use of resource capacity. The federal government and key financial information focuses on expenditure control. The key to effectively managing costs is understanding the characteristics and managing the use of the vast federal resource capacity. Financial managers spend a lot of time tracking money with commitments, obligations, undelivered orders, unliquidated orders, accrued expenditures, outlays, etc. Far less time is spent analyzing the same level of detail in resource capacity use. There's various categories, but some fairly universal ones are productive time, when a resource is doing what you hired or acquired it to do. Non-productive time, when a resource is engaged in necessary but not productive activities such as maintenance, training, or repair. And of course, excess or idle time, when a resource isn't used or when it's kept ready due to lack of demand or management choices or legal restrictions. The analysis of resource utilization and the associated cost patterns are far more relevant to management improving efficiency, effectiveness, cost control, and optimization than mere expenditure control. And the final issue is that federal cost systems don't place a priority on accurately reflecting resources, processes, and causal relationships for planning. Again, we have the focus on fund control rather than resource application and optimization, and federal cost systems should prioritize accurately reflecting those resources, processes, and causal relationships. This issue is somewhat related to issue 3. Federal costing systems are primarily backward-looking because they're designed to support financial accounting and reporting. However, this isn't a fundamental flaw. The principal shortcoming of the current approach is the failure to reflect causal resource and process relationships, which is impossible for an accounting system that must comply with financial accounting and reporting standards that don't even include causality. Planning and budgeting are primarily related to operational and resource planning for mission, resources, and the necessary levels of support and administration. Since the clarity of the connection between operational systems and financial systems is impaired by traditional costing done to support financial reporting standards, it normally requires considerable effort, a great many extrapolations, and broad estimates to make financial accounting data connect to existing and projected changes in resources and processes. For example, if all you know about the cost of personnel administration is the cost of the central processing center and the regional centers is the total cost, if that's all you know is the total cost, how would you assess the impact of adding or reducing a brigade, say 10 to 15,000 troops? The typical answer is to divide the total number of centers, the total cost of the centers, by the cost of all the personnel supported. Yet a brigade has more junior personnel and is deployed more often for operations or training. Do these or other factors impact the personnel administrative resources? One will never know from the financial accounting system. This requires managerial costing. So these are the issues. We have 4 recommendations to go along with them. Recommendation 1 is that the federal government should go beyond the standards in Statement 4 and require causal modeling to ensure that agencies use correct information for decision making. The new information should focus on reflecting causal relationships, resource capacity employment, and supporting effective marginal and incremental analysis. The test of effectiveness of a costing system should be widely used by managers, it should be widely used by managers and budget personnel at all levels of management and oversight. Recommendation 2. Federal government should prescribe analytical doctrine and decision-making information that departs from financial reporting and compliance regulations and places dominance on causality. The federal government should improve its focus on the creation of internal cost and operational information needed to optimize resource use, operations, and costs. In a constrained budget environment, cost information is needed to do more with the same or less, and to ensure that every dollar counts. Achieving this requires detailed insights into the use of resources, their costs that tie logically and very directly to operations, outputs, and performance results. A specific example is the Economy Act of 1932. The Economy Act and the associated regulations should be amended to allow and encourage federal cross-servicing at marginal cost rates in those cases where unused capacity has been paid for by the taxpayers and is available for use. Our third recommendation is that federal financial and resource management doctrines need to emphasize capacity management and optimization rather than expense control. The federal government is made up of massive quantities of resources, people, and physical assets. The capacity is used to produce outputs and results, outcomes. The information and reports don't currently exist that quantify resource capacities in an effective manner. Additionally, the definitions of use of resource capacity, productive, non-productive, idle or excess, and perhaps one could say for the federal government in many cases, standby for emergencies, hasn't been established across the government. Understanding the quantity of resource capacity, the characteristics of its use, and the availability is essential for better resource management and optimum resourcing and budgeting. Finally, recommendation number 4. Budget protocols should be reoriented to causal cost, resource, and operational information. Oversight focus should de-emphasize expenditures to focus on resource optimization. Federal agency budgets need to be constructed on a cause and effect basis using anticipated resource capacities, resource and process performance, and levels of activity for a given level of service. Systematic and documentable cause and effect cost, resource capacity, and operational information need to be the foundation for planning, budgeting at all levels of approval and oversight. So this last slide simply goes back to resource consumption accounting. If you want to improve your decision support information, RCA is really the best way to go. Back in 2008, the International Federation of Accountants sponsored the creation of a costing continuum with identifying the levels of maturity, and resource consumption accounting was identified as the most mature approach to doing costing, particularly when it came to demand-driven planning with capacity sensitivity, which is extremely important for the federal government. Real-time simulation was rated higher, but I would argue that if you want to do real-time simulation, you need to do resource consumption accounting to create your inputs. I hope I've given you a sense of, number one, how costing in the U.S. federal government can be improved and how RCA could contribute to that process, as well as the usefulness of the IMA's Conceptual Framework of Management Accounting in characterizing a new view of costing within the federal government. Thank you very much. I'll turn off the recording and I'll open it up for comments.